All right, let's get right to it. As of 10:06 a.m. Eastern Time on October 30th, 2025, the U.S. markets are open and extremely active. Shares of Alphabet, Class A stock, ticker GOOGL, are trading at $289.11. That is a massive move, up over $14.50 on the day, a surge of 5.3%. The stock gapped up at the opening bell to hit $291.59, a new 52-week high, and has pulled back just slightly, but it is holding on to these tremendous gains on exceptionally high volume. By 10 a.m., over 20 million shares have already changed hands, well on its way to smashing its 30-day average volume of 30 million. This isn't just a green day, this is an explosive, decisive breakout. And the immediate question is why? The answer is that Wall Street just got a massive wake-up call. The expectation, the narrative that has been building for the last year was that Alphabet was in a desperate, margin-crushing spending war with Microsoft to keep up on AI. The belief was that its core search business was under threat, that its ad-based model was fragile in this new environment, and that the costs of building out its AI infrastructure would eat its profits alive. That was the expectation. The reality delivered yesterday after the bell in its third-quarter earnings report was an absolute demolition of that entire narrative. Alphabet just reported its first-ever $100 billion revenue quarter. Let me say that again. Over $102 billion in sales in just 3 months. This wasn't a company just surviving the AI transition. This was a company proving it will dominate it. The market priced in a fight. Alphabet delivered a knockout. Let's be clear about what the market was watching. Investors using Fidelity investments or checking their Schwab Intelligent portfolios were worried. They saw the headlines about NVIDIA stock and the billions required for GPUs. They saw Tesla stock struggle after its own recent earnings, and they were bracing for a similar high-cost, low-return story from Google. The expectation was that ad revenue would be flat, and cloud growth would be slowing. The reality? Google search revenue, the core cash flow engine, wasn't flat. It was up a staggering 15% year-over-year to $56.5 billion. YouTube ads, another area of concern, beat expectations, coming in at $10.2 billion. The ad business isn't dying, it's accelerating. But the real story, the one that has analysts scrambling to update their models, is Google Cloud. The narrative was that it's a distant, unprofitable third place to Amazon and Microsoft. The reality? Google Cloud revenue surged 34% to $15.2 billion, beating estimates. Even more importantly, its operating income from cloud more than doubled from this time last year, hitting $3.6 billion. It's not just growing, it's becoming a profit-generating monster in its own right with a $155 billion backlog. This is why we are seeing this violent repricing today. This isn't a small beat. It's a fundamental reset of what the market thinks Alphabet is worth. The stock is gapping up to a market cap well over $3.4 trillion. This single-day move is adding more in value than the entire market cap of many S&P 500 companies. For investors who do their own self-investing, this is a classic expectation versus reality gap closing in real time. If you were short this name, you are in a world of pain today. If you were a long-term holder, perhaps in a Fidelity IRA or a SoFi Invest account, your patience is being handsomely rewarded. The conversation has completely shifted. The question is no longer, can Google survive the AI transition? The question is, how much will Google profit from it? And this brings us to the most contentious part of the report, spending. Alphabet announced it is increasing its capital expenditure forecast for the year to a range of $91 to $93 billion. A few quarters ago, a number like that would have sent the stock plummeting. The market would have seen it as pure cost. But because the company also just printed $102 billion in revenue and expanded its operating margins, the market sees this spending for what it is, an investment. They are pouring fuel on the fire. They are building the data centers, buying the chips, and expanding the infrastructure to service that $155 billion cloud backlog and power the next generation of AI search. This is what leadership looks like. They are spending from a position of strength, not desperation. This is a very different setup from what we see in other parts of the market. It's not like Apple stock, which is reporting later today and faces questions about iPhone demand in a slowing hardware market. Google just proved its digital services are more resilient than ever. The trading action today is fascinating. Retail investors, many using the Robinhood app or SoFi investing platform, are almost certainly chasing this momentum. The high volume shows that major institutions, the large Fidelity mutual funds and pension funds, are also piling in, forced to reallocate. They can't afford to be underweight on this name if this growth is real. More sophisticated traders, perhaps using interactive brokers, are likely looking at the options chain, where implied volatility is collapsing after the earnings event, but the call option volume remains extremely high as traders bet on further upside. This is a full-scale, market-wide reevaluation. So, for those who are just tuning in or are new to this company, what does Alphabet actually do? It's easy to forget when we're focused on the daily stock swings. Alphabet is the parent company of Google. Its business is broken into three main parts. First, Google Services. This is the behemoth. It includes Google Search, the YouTube video platform, the Android mobile operating system, the Chrome browser, and hardware like the Pixel phones. This entire segment makes the vast majority of its income from advertising. It's one of the most powerful business models ever created. Second, Google Cloud. This is the enterprise-facing division. It sells cloud computing power, GCP or Google Cloud Platform, and productivity software, Google Workspace, which competes with Microsoft Office. This is the high-growth engine, competing directly with Amazon AWS and Microsoft Azure. As the earnings report just showed, this division is hitting a critical inflection point of profitability and scale. For investors, this is providing a floor for the valuation that simply wasn't there 5 years ago. This is where the online investment community is really focusing. They are looking at the growth rates of AWS and Azure and seeing that Google's 34% growth is outpacing them, meaning it's actively taking market share. The third catalyst is the wild card, other bets, specifically Waymo. On the earnings call, CEO Sundar Pichai specifically highlighted Waymo's progress. This is important. Just last week, on October 22nd, reports confirmed that Waymo is planning its first major international expansion, targeting a 2026 launch in London. It's also already testing in Tokyo. Here in the US, it's expanding its commercial ride-hailing services. While the Other Bets division is still losing some income, it reported $344 million in revenue but a loss. Waymo is the asset that could one day be worth another $1 trillion on its own. It's a long-term call option on the future of transportation, and it's embedded inside Google stock for free right now. Now we have to talk about the risks. No stock is a straight line up, not even one with this much momentum. The primary risk remains regulation. The Department of Justice antitrust trial is ongoing. While sentiment recently suggests the outcome might be less severe than feared, which has helped the stock climb since September, a harsh ruling that forces the company to break up or change its business practices remains a significant, if distant, threat. The company also just booked a $3.5 billion fine from the European Commission this quarter, a reminder that the regulators are always watching. The second risk is pure competition. Microsoft isn't giving up. It is embedding AI into everything. And just days ago, a new threat emerged. Reports of an Atlas browser from OpenAI, a direct shot at Google Chrome and Search. The war is not over. Finally, there's macroeconomic risk. Alphabet just proved its ad business is resilient, but if a severe global recession hits, ad budgets are always the first thing to get cut. Today's report suggests Google is immune, but no company truly is. Before we wrap this up, I want to hear from you. We just saw Alphabet raise its spending plans to over $90 billion to build out its AI future. Comment below. Do you think this massive spending is a brilliant strategic move to secure its dominance, or is it the beginning of an unsustainable AI spending bubble? Let me know what you think. So, as we look at the screen, with GOOGL stock holding a 5.3% gain at $289, the story is clear. The expectation was that Alphabet was a maturing giant, a legacy company fending off disruptors and drowning in new costs. The reality, as proven by the numbers, is that this $3.4 trillion behemoth is a growth company. It just printed its first $100 billion quarter, its core ad business is accelerating, and its cloud division is doubling its profits. The market has been forced to abandon the old fearful narrative and adopt a new one. That the AI build-out isn't a threat to Google's margins, it's the very foundation of its next decade of growth.